Welcome to The Explainer. Today, we're putting the high-growth medtech company BFLY Network through an absolutely rigorous stress test. You know, as an investment analyst, it's just not enough to casually glance at a stock chart. We really need to tear down the financials using the proven, battle-tested frameworks of legendary investors, guys like Warren Buffett, Peter Lynch, and Benjamin Graham, alongside modern discounted cash flow models. So let's dive right in and see if BFLY Network can actually survive the ultimate valuation gauntlet.
All right, here's our roadmap for today. We'll kick things off with a company snapshot, then run the stock through the Warren Buffett lens, the Peter Lynch lens, and the Benjamin Graham lens. After that, we'll crunch the numbers on a DCF and some alternative valuations before wrapping it all up with our final verdict.
First up, Section 1, a quick company snapshot of this med tech innovator.
$7.01. That's BFLY's current share price right now. And if we multiply that by the roughly 256.5 million shares outstanding, well, we get a market cap of about $1.83 billion. So we're essentially looking at a small to mid-cap player in the medical device sector.
And this right here perfectly highlights the core tension of our entire analysis today. BFLY Network is an incredible innovator, right? They're the literal pioneers of ultrasound-on-chip technology, having just rolled out their highly praised IQ3 device. Their top-line revenue for Q1 2026 hit $26.5 million, which is a really robust 25% year-over-year growth. Even better, a richer product mix has pushed their gross margins up to nearly 69%. They've got a solid $138 million in cash on hand. But, and this is a massive but, they are still unprofitable, posting a net loss of $12.7 million for the quarter.
Moving right along to Section 2, the Warren Buffett lens, where we're seeking out that elusive economic moat.
So how does BFLY hold up? Well, they absolutely nail the economic moat criteria. Their proprietary semiconductor and AI-driven ultrasound tech is a massive, massive competitive advantage. They'd also passed the debt test with flying colors, armed with a strong cash base where total assets far outweigh their liabilities. However, Buffett is notoriously strict about consistent earnings and a high return on equity. With a projected 2026 net loss of over $55 million, BFLY totally fails those tests. And maybe more importantly, Buffett focuses heavily on owner earnings, which is essentially free cash flow. With projected free cash flow sitting at negative $80 million, there are literally no owner earnings to speak of here.
So what's the verdict from the Oracle of Omaha? He definitely wouldn't die at $7.01. Because the cash flow is currently negative, it's virtually impossible to calculate a reliable intrinsic value using his traditional owner earnings discount method. Honestly, he'd just wait patiently on the sidelines until the company actually scales to profitability, establishing a true margin of safety.
Okay, let's shift gears to Section 3, the Peter Lynch lens, focusing on growth and ownership.
Now, Peter Lynch would instantly categorize BFLY Network as a fast grower, since they're expanding revenue at 20% to 25% a year. And look at that ownership breakdown. Institutional investors hold just under 38% of the shares. Lynch actually views low institutional ownership as a massive positive. It means that as the company continues to prove its profitability over time, there's plenty of room for those huge mutual funds and pensions to start buying in, which can drive the stock price significantly higher.
Plus, if we dig into the recent 13F filings, the smart money inflows are absolutely crushing the outflows by more than 3 to 1. Over the last 12 months, 109 different institutions bought the stock, pouring in over $85 million. Meanwhile, only 39 sold, withdrawing about $25 million. That is a very bullish signal.
So the Lynch verdict? It's a speculative buy. We can't actually calculate his beloved PEG ratio because, again, we have no positive earnings to work with, but Lynch would likely see this as a really intriguing speculative play. They've got a strong enough balance sheet to survive the current cash burn, undeniable momentum in institutional buying, and a simply massive runway for growth.
Next up, Section 4, the Benjamin Graham lens. Time for some deep value defense.
Listen, Graham's defensive investor checklist is completely unforgiving to modern high-growth tech startups. Running down the criteria, BFLY Network fails almost every single traditional metric here. It falls just short of its typical $2 billion size requirement. It has zero earnings stability with that negative EPS. It pays absolutely no dividends, and with a price-to-book ratio of roughly 9.4, it completely blows past his strict 1.5 times limit. Literally, the only saving grace is its strong financial condition, with cash far exceeding current liabilities.
And honestly, this perfectly exposes the major limitation of those old-school value formulas.
Graham's famous intrinsic value formula multiplies earnings per share by book value per share. But when a company like BFLY is heavily investing in growth at the total expense of current earnings, projecting a negative 13-cent EPS for 2026, Graham's math literally breaks down. Under the Graham lens, this stock is an immediate hard pass.
All right, since the historical models are struggling a bit, let's look forward with Section 5, DCF and alternative valuations.
Wall Street analysts are projecting some seriously strong, consistent top-line revenue growth here, scaling from about $82 million in 2024 all the way up to nearly $120 million by the end of 2026. That trajectory, combined with those expanding gross margins hitting 69%, gives us a really solid baseline to build out a discounted cash flow model.
To actually build our DCF model, we've got to make some educated industry assumptions. We essentially have to forecast revenue and margin expansion out until BFLY stops burning cash and reaches maturity. Then, we calculate a terminal value and discount it all back to today using a weighted average cost of capital, or WACC. For a growth medtech company with zero debt, a 10% discount rate is a pretty standard, safe assumption. Now, what's really fascinating about this sensitivity table is how perfectly it frames the current price. If we assume our baseline 10% cost of capital and a standard 3% terminal growth rate, the fair value lands at exactly $6.80 per share. Notice how tightly that straddles our current trading price of $7.01. If management executes slightly better than expected and commands an 8% cost of capital, well, that fair value jumps to near $10. But if they stumble, it drops down to $4.50. Checking out a few alternative valuation models, BFLY is trading at a somewhat premium 14.2 times enterprise value to revenue multiple for 2026. But get this, when we look at the Wall Street consensus, 5 different analysts maintain a strong buy rating with an average price target of $7.06. That perfectly aligns with today's actual trading price, which really suggests the broader market is pricing in the current fundamentals with laser precision.
Finally, we've arrived at Section 6, our synthesis and final verdict.
Let's tie this whole thing together. Ultimately, BFLY is a deeply mixed bag, and it totally depends on your specific investment philosophy. It bombs the strict deep value tests of Benjamin Graham and Warren Buffett because of those ongoing net losses and negative cash flow. But it passes Peter Lynch's growth tests with flying colors, heavily buoyed by that institutional accumulation. And our forward-looking DCF and analyst models show the stock is currently trading right at fair value. So my final verdict as an analyst, if you're a strict value investor, this is a hold. Just wait for profitability. But if you have a high risk tolerance and you're hunting for growth, it's a very solid speculative buy based on their widening technological moat and that impressive margin expansion. So I'm going to leave you with a question to ponder for your own portfolio. With rising margins but an ongoing cash burn, is BFLY Network's technological moat actually wide enough to give you a true margin of safety? Thank you so much for joining this explainer, and as always, keep questioning the numbers.